Ladies and gentlemen, welcome back. In this video, I want to talk about Wall Street's insane 2025 guidance numbers. We touched on this in the last video, but I didn't end up showing it from a year-over-year perspective, and there's a lot more detail that I have from management's perspective to add some more clarity here as well. But before we do that, once again, we need to talk about another 52-week high today of $12.19. It's even holding above the previous 52-week high today, even though it's dropped a little bit down to 1174, but that's higher than the 52-week high that we've had previously. Thank you to all the bears and naysayers for making that one happen. Couldn't have done it without you. Just kidding. It made it worse, but that's fine. You know what? We stuck through. We're holders, and yeah. Now, let's talk about the numbers, okay? Because this is what Wall Street is saying. They are extremely negative on this company and have had to just continuously bump up their EPS numbers. And by the way, not just Wall Street analysts, which I have first account of them being negative of this company talking directly to me, but also hedge fund managers that are talking to me about how this is a fake business, how they do not make money, and yet they continue to reevaluate this company that's looking better and better. So we talked about this in the previous video, okay? Where all of their numbers are projected for and where it's going next. But in 2025, I was talking about where they were before in their estimates to where they were now, but we didn't really talk about what these numbers represent. So in this video, that's what I want to talk about, which are these new charts that I have here, which are talking about the growth rates. So if you assume EPS of 13 cents in 2024 and then 28 cents, which is Wall Street's consensus, which we showed off in these numbers right here. But if 28 cents is your consensus for 2025, that's 115% increase, okay? And for revenue, which is the most interesting part in my opinion, if you're assuming 2.55 billion and then next year you're assuming just under $3 billion, you're only looking at a 17% increase year over year on revenue. Okay. New Bank, we're not going to look at right now, but those are their numbers, a little bit more reasonable in terms of EPS growth growing faster than revenue because margin expansion, but also still high levels of revenue growth at 30%. SoFi, not so much. Now, I wanted to go through with you guys and talk about why I believe that this is just simply crazy. First off, product growth for SoFi, which also passed like 13 million new products, grew 37% year over year whenever excluding crypto accounts, okay? They are probably going to hold up a very similar rate year over year, considering they are now net income positive. They have more money to throw towards sales and marketing. I believe that they're going to bring in new products at least over 35% year over year, considering cross-sell is probably going to accelerate in the years to come, as well as just new member counts and bringing it over. And plus, new product additions that SoFi could potentially be getting into, whether that's SMB accounts or something like this. There are new products that could also be cross-sold. So 35% year over year. Let's imagine the same amount of revenue per user or per product. We're already looking at 30+% revenue growth rates, but that could actually be shrinking, right? If there's more financial services products than there are lending products, then that could bring down revenue per product. However, average revenue per product actually rose year over year in the most recent quarter, Q3, by 52% year over year to $81 per product, okay? So not only has revenue per product been expanding, which whenever we were first covering it was just around the $20 mark, now it's over the $80 mark, and that's continuously growing. Well, product growth has also accelerated, okay? So with 13 million products, $81 per product, I do believe that that's going to continue to expand. And it's not just my perception of this. This is also Anthony Noto's, the CEO. He recently just said in the last earnings call, he said, as it relates to our invest business, which is their actual brokerage side and their services there, they said, we're monetizing at about half the rate that we think that we could monetize it over time. So this could end up doubling at some point in their invest business, which is millions of products, okay? They believe that both credit cards and SoFi Invest can get to the level of their checking and savings product, which is SoFi Money, which would absolutely drastically accelerate revenue, not to mention credit cards. They just launched 2 new credit cards there. And they'll begin cross-selling those to their 10 million plus members in 2025, okay? So With the added benefit of SoFi Invest starting to potentially try to get towards that doubling in monetization, brand new credit cards, which are cross selling to new members. And if we even take a look here, let me go, I'm improvising a little bit here. Let's go take a look at debit usage for each member. So this is debit interchange volumes ever since SoFi became a bank, right? And they actually started to talk about their volumes. So in the bars is the amount of billions of dollars that they end up getting per quarter, roughly, in debit interchange volume. And then in the orange line here is the amount of spend that we get on debit per quarter, or sorry, per person per quarter. Okay. So the more users that we've even brought onto SoFi Money, which is hitting all new highs, is also still getting new debit spend per user, even though they're expanding there. Okay. What's so interesting about that is the new credit card offering that they're trying to go after would actually end up potentially 3 to 5xing the amount of revenue that SoFi is expecting for interchange for credit cards rather than debit cards. Okay. Just the way it works, let alone, the revolving credit aspect and everything like this that would add on to that revenue. I'm not even talking about EPS. Okay. EPS, by the way, if you guys are thinking about SoFi, if it's even possible for them to hit 115%, there's a very easy way to think about it. Okay. Every dollar that they bring in, they're trying to have an incremental 20% net income margin. Okay. Which means previously they've had much lower rates than that, but they now think that they can get up to 20%. Right now, we're at about 8% net income margin. So every new dollar that comes in at a 20% income margin is essentially doubling the amount of EPS that we get per amount of revenue that is flowing into the business. Adjusted EBITDA is around a 30% incremental margin. So 115%, I think, is absolutely viable. And in fact, it'll probably beat that if revenue is also expected to grow way faster than expectations. So I expect EPS to double even on the amount of revenue that we're bringing in. But if we can end up accelerating revenue even faster than that, well, there's a lot more upside there. Let alone because Trump, it looks like he might be actually winning the election. There might be cuts to corporate tax rates, which are also good for EPS, but not really affecting revenue. There might be a way that it affects revenue in terms of, tech platform regulation. If companies now think that there's more clarity for them to actually sign these deals, that could be revenue accretive. But yeah, whenever it comes to the tech platform as well, because essentially this year, the tech platform might grow at somewhere around 17%. In order for that platform to hold up its growth rate, they would just need to do exactly what they did last year, which is in a transitional year. So obviously they're expecting to do better than this. Anthony Noto believes that they can hold up anywhere between a 20 to 25% growth rate going forward. So I think that will accelerate. And then the last part about beating their revenue is whether lending or not is going to hold up. In my opinion, a transitional year in a bad macro environment where they expected contraction in revenue on lending, that actually turned out to not be the case, and lending's actually going to grow. Margins are expected to expand in a transitional year. Whenever we have the best macro environment, according to Anthony Noto, and this was before Trump ended up taking office, which he declared that would be more favorable for his business. These are not my words, these are his words.
The conversation about the presidential election is front and center here in Sun Valley. What outcome do you think would be best for the economy and for your business in particular?
I'd be lying to you and being, less than disingenuous if I didn't say our business would benefit from a Republican administration. There's more capital markets activity. There's more M&A activity. I want our country to be very strong and vibrant. And on one particular day, I'll be rooting for one particular party.
That the best favorable macro environment in 7 years would be something that may affect lending in a positive light. So why don't we take a look at future investing's estimates, myself, I don't know, I'm talking to myself in third person, and Wall Street's estimates for total revenue. So they expect 2.99 billion, or about a 17.5% year-over-year change. The year-over-year change percent that I'm choosing is based off what they think the last year is going to end at, which is 2.55 billion. I actually think it'll be slightly higher than that. So my year-over-year rate is going to be a little bit different, actually slightly lower, because I think 2024 will be stronger. Okay. They do not. They think 17%. I think 33.3%. Okay, $3.4 billion of revenue in 2025 as a very preliminary number that is so subject to change as we get more and more data. But this is just a first look at what we know about the macro and what we know about SoFi's ability to grow from, historical numbers. Now, segment level data, Wall Street does not have consensus on this. There is no numbers that we can look into unless they break it down like each individual company might have theirs, but they don't disclose that. Lending, I think, will be a 20% year over year growth rate from the year prior, because we are no longer in a transitional year. We'll be able to sell loans, and that's not including the loan platform business, which Anthony Noto, whenever talking with an analyst, Jeff Adelson, he said, do you expect something along the lines of around $6 billion of loan originations for the loan platform business? Remember, last quarter, Q3, was the only time that we even had this platform, and we did $1 billion. So they think that there's going to be an acceleration, or a continuous 1 billion plus an additional 50% each quarter in 2025. And Noto said the outlook for 2025 is significant and probably in excess of what you've articulated, which was the 6 billion. So he thinks there could be potentially 6, 7, 8 billion dollars in the loan platform business. If that brings on 5 to 6% like it did this quarter, you're looking at potentially 300 to 400 million of additional revenue that wasn't even counted in the business previously. That actually does fall under financial services, but it does mean great things for the lending platform as well, because it means that there's buyers there for the loans. It means that they can originate more, and their cap ratio is really high right now, which means even if they don't sell loans, they could still originate more. Financial services, I think, will grow just around 50% or $1.2 billion. And the tech platform around 22.9% or about $500 million. And this is me being very conservative because, it's a very hard platform to sort of judge. So just in easy numbers, you can see, maybe this is also just my assumption, but Wall Street is so undercutting what SoFi could do in 2025. But ladies and gentlemen, that's the video. If you want to see more content like this in fintech and tech in general, make sure you guys subscribe down below.